Once again, good afternoon, investors. My name is Lindsay Walsh, and I am joined today by Nick Ambrosic, Andy Ton, Emily Richards, and Harmon Dott. Welcome to our investment presentation on Service Equipment Corporation. After performing a company evaluation, we have derived a target price for service of $5.55 Canadian. This represents a 6.1% downside from the share price on April 17, 2020, and leads us to issue a sell recommendation on the holding. There are three key investment drivers behind this sell recommendation. The first is that Service is currently experiencing a poor macroeconomic environment in its two largest business lines: agriculture, which we see as highly tied to the health of Canadian farmer balance sheets, particularly in Western Canada, which we have seen struggle lately, as well as transportation, which is highly tied to Canadian macroeconomic health, which we have also seen depress. It should also be noted that the company expects all three of their business lines to be negatively impacted by COVID-19. Secondly, we have seen that Service historically struggles to provide value to their shareholders. This can be seen through decreasing gross profit margins, a weak net profit margin in comparison to peers, as well as poor inventory management, demonstrated through decreasing inventory turnover ratios. Finally, we believe that the company's 50-50 target plan, which we will get into more later on, is overly ambitious and will be difficult for Service to materialize. To go into a brief company overview, Service is a specialized equipment dealer and product support specialist. They operate in three different business lines, the largest being agriculture, followed by transportation and then industrial, in three different geographical locations, the largest being Western Canada, followed by Ontario, and then Australia and New Zealand. Throughout these three business lines, they derive their revenue in three different ways, the largest being new equipment sales, followed by used equipment sales, and then product support revenue.
When looking at the original equipment manufacturers, Service offers different brands within each segment. For agriculture, they offer John Deere, which is a leading brand in the industry, and they consider themselves more of a technology company as they focus on precision agriculture. For transportation, they offer Peterbilt, which is also a leading brand and has good resale value. For industrial, they offer JLG, Clark, Doosan, among others. For competitors, specifically for John Deere, they predominantly go up against Case IH and New Holland products, which are both lower cost and lower quality alternatives. For transportation, Peterbilt faces up against Kenworth, which is part of the parent company PACCAR, which also sells Peterbilt, Freightliner, International, and Volvo. When looking at the competitive landscape, we identified 5 public companies in which we looked at their size, the geography of their operations, and the industry in which they operate. We found that Finning, Rocky Mountain, and Wajax were the most comparable, and they provided a holistic and accurate representation of the sentiment surrounding operating equipment dealerships in Canada. Some factors to consider is that Service competes against both public and private dealerships in a highly fragmented market. They benefit from their scale and their premium OEM brands. However, they do face a lot of competition as competitors offer lower cost alternatives, and OEMs can displace them completely. However, we believe Service competes favorably in a strong economic environment.
Within the three segments, there are a few key investment considerations that we had to take into account. So starting off with agriculture would be China's canola tariffs. In 2018, China made up 45% of Canada's canola exports. As seen on the graph to the right, Western Canada is heavily reliant on these canola exports. Secondly would be trade relations between Canada and the US. With the recently signed Phase 1 trade deal between China and the US, China is now mandated to purchase a larger amount of US goods. With this deal, Canada may be displaced among its trading partners. Lastly, a demographic shift. We're seeing a trend of increased farm consolidation, and this, along with increased debt on farmers' balance sheets, will lead to a negative environment for equipment purchases in the future. In the transportation segment, we're seeing increasing labor costs due to mass driver exodus. As well, we're seeing freight deterioration related to general trade uncertainties, as well as a tumultuous macroeconomic environment. And this can be seen on the graph to the right with the US PMI index, as well as Class 8 truck orders on a decline. As well, we're seeing increasingly stringent environmental and industry regulations. In the industrial segment, industrial real estate demand is currently very strong, and this is largely due to an increase in e-commerce sales. So a lot of these e-commerce companies require additional warehouse storage, and we're seeing this play out in terms of low vacancy rates across most parts of Canada. So overall, the macroeconomic headwinds in agriculture and transportation, we believe, will outweigh this industrial growth. The second pillar to our sell thesis for Service is that the company has long struggled to provide value to its shareholders, and we can see this through a lack of a clear trend in their top line growth, a lower net profit margin relative to its peers, significant underperformance relative to the broader market, and a history of rescinding shareholder benefits during troubling times. So overall, this past performance does raise concerns for future improvements.
So shifting gears, we'd like to emphasize that Service is actually integrating a new CEO. Angela Lakatzis joined Service in May of 2019 after previously being a VP at Nutrien. Under her guidance, Service unveiled a new 5-year plan, highlighting a 50-50 revenue split between product sales and equipment sales and product support, a 20% return on invested capital goal versus a historic 8 to 13%, as well as a 10% absorption increase. So what we'd like to emphasize here is that they expect material revenue growth and internal improvements while integrating new management. So diving a little bit deeper into what this plan actually entails, as you can see by this graph on the right here, currently 23% of their revenue comes from product support. So in order to realize these 50-50 targets, significant inorganic growth needs to occur. In fact, Service cited 75% of this growth has to be inorganic. However, we don't believe the market has these opportunities right now. For example, their competitor Rocky Mountain Equipment recently had to rescind a similar 5-year plan, citing a lack of accretive M&A opportunities. In addition, we'd like to highlight that their $200 million capital investment program we believe will be incongruent with the return on invested capital goal. So with this chart here, you can see that Service has had significant price suppression over the past year, despite the new CEO and their new strategic plan. And we believe that there will be a further price suppression if this 5-year plan is not materialized and there's further mistrust between investors and management. Overall, Service is multifaceted issues with both a poor macroeconomic environment and long-term internal issues. So we believe that their attempts to improve internal operations and improve top-line growth will not be realized in an unfavorable internal and external environment, and it will lead to them missing their 50-50 goals and lead to further price suppression.
Moving into the valuation aspect, to gather an intrinsic valuation of the firm, we employed a DCF, providing us segmented operating assumptions given the varying realities as highlighted with agriculture, transportation, and industrial. Moving into inventory turnovers, this is a key revenue driver for the firm, and we could see this on the downtrend into 2019 due to an overpopulation of used equipment, but we modeled this to forecast out into a normalized 3.4 times by the terminal year. With our free cash flow build out, given the $200 million capital investment program, this elevates their CapEx profile, ultimately cutting into their free cash flow generation. And with a perpetual growth rate, we stuck with 2.1%, given that 90% of the firm's operating exposure lies within Canada, and the long-term GDP growth rate there makes sense. Finally, with the cost of capital, with our cost of equity, we employed the Canadian 10-year risk-free rate, Demodern's equity risk premium, and Ibbitson's small cap risk premium, given the fact that this is a $90 million market cap company. With the beta, we gathered a weighted average from Demodern's sources using the various betas for agriculture, transportation, and industrial. When levering this back to the firm's capital structure and combining this with the cost of debt of 4.69%, we get a weighted average cost of capital of 8.06%. And combining our assumptions together, this gave us a base case DCF target price of $5.38. Moving into the comparables analysis, to gather a relative valuation of the firm, we employed the 3 companies mentioned earlier in Rocky Mountain Equipment, Finning, and Wajax. And when using a 2021 median EV/EBITDA, just given the fact that 2020 has been difficult to assess with COVID, this gave us a price target of $6.22. So combining these two methodologies with an 80% weighting towards our DCF, a 20% weighting towards our comparables analysis, we get a price target of $5.55.
1 minute remaining.
To round off our presentation today, we would like to discuss some risks that we see affecting our valuation as well as the company holistically. They can be separated into 2 different categories. So first, we're looking at integration risk, which would be the risk that the company does not adhere well to those new management teams as well as that new management goal. This flows directly into acquisition risk, which would be the inability of the company to find those new inorganic growth opportunities that were so crucial to that new 50-50 target plan. Finally, this flows directly into the 50-50 target plan and the overall general risk that the company is unable to reach those new goals. We'd also like to highlight supplier risk. Given that Service is in an intermediary position in the supply chain, we do see them highly at risk to the will of the OEMs. In conclusion today, we place a sell recommendation on Service Equipment Corporation, citing a poor macroeconomic environment, historical value struggle, as well as overly ambitious growth targets. We thank you for your time today and would love to open up the floor to any questions.
Hello, this is Lauren. Thank you so much for your time today and your participation. I'd agree with you that the long-term economic growth rate for Canada is a reasonable assumption to use these models under normal circumstances. Of course, we know now that it might not be a reasonable assumption moving forward. So let's say that the growth rate for Canada is instead 1% for the next 10 years or 0%. How would that impact your valuation, your expectation for those valuations generally? And how would you expect that lower economic growth would impact the company relative to its competitors?
In terms of the valuation side, of course, it is a very possible given the impacts of COVID that are yet to be seen. In terms of that aspect, agriculture might not be as severely impacted as other segments, but transportation and industrial are very linked to the economic growth and health of the country. So with that, it would definitely hamper growth prospects there. And those are two regions where the company is focused on more profitable growth to aid with that product support goal of 50% revenue and increasing the gross profit on that side of the business.
Overall, the gross margins on this business seem quite low. Now, is that because of the margins on the used equipment side? Is that primarily agricultural used equipment? And you also mentioned sort of the third element here beyond new equipment sales was product revenues. Now, I assume that means parts and service. If you were describing to management a solution for maybe improving their profitability, are there other avenues that you would recommend?
So what we're seeing with why the gross margin is so low in general is exactly what you said. It has a lot to do with the used equipment inventory. We're seeing in Canada right now, based off some auction statistics, that most of this used inventory is going for about 75% of the full retail pricing. We're also seeing that new equipment doesn't have that like 100% MSRP pricing that we like to see in some retail businesses. So they're obviously losing quite a bit of margin there. You hit the nail right on the head again with the product support revenue. It does have to do with parts and services. From our perspective, because product support is so much more profitable for the company in general, being able to increase those product support revenues, which is in the 50-50 target goal for the company, would absolutely be vital in terms of trying to help them increase their growth margin. Where we're going to see that this becomes a problem for service and why we ultimately still have the company as a sell is that Rocky Mountain Equipment also recently rescinded their 50-50 target plan because those inorganic growth opportunities just simply do not exist in Western Canada and Canada as a whole right now for these types of companies. So when we're looking at Service, who's saying that a lot of their new product support revenue is going to have to come from these inorganic growth opportunities, simply seeing that they do not have them available to them in the market and having that be the biggest way to increase gross margin, we see that being an underlying issue.
We look at the valuation for a moment. Can you explain how you came up with the split of 80% DCF and 20% on comps?
Yeah, for sure. So we put more emphasis on our DCF because we think that it more accurately reflects the actual factors such as inventory turnover and floor plan payables. We put less emphasis on our comparables because there isn't a perfect comparable for service. The most comparable is Rocky Mountain, just because of their geographic exposure and their more emphasis towards agriculture. And that's why we included comparables such as Wajax and Finning, because they do provide that sentiment around operating equipment dealers in Canada. However, it isn't a perfect representation, and therefore we put less emphasis on that valuation method.
Thank you.
Talk about the structure. I'm sorry. I'll have someone
No, go
else.
ahead.
Talk to me about the structure of the debt. You know, I think dealers like this often use floor plan financing. How significant is that here?
With service, it definitely is a significant portion. And given the fact that it's a low margin business, any sort of dealer rebates that they can capitalize on ultimately boost that profitability. With their floor plans, they also have revolving credit facilities with some banks like TD, Wells Fargo, and CIBC. But a majority of it does come from John Deere, from the agriculture side. And yeah, that would ultimately, their floor plan payables as a total would be roughly around 180 million. And again, of course, this would tie to the receipt of receivables for the equipment that they on-take and sell afterwards. But ultimately, a lot of this is a variable rate. So given the move towards lower interest rates, hopefully that could buffer the blow. But if they're unable to turn over that inventory in the coming year, it'll still be on the books and prolong that equipment risk.
Thank you.
How much of an opportunity does this company's tangible asset value or tangible book value per share offer to perhaps a shareholder activist in terms of his ability to gain control of the company, liquidate inventory, and make a sizable profit?
I can speak in terms of the liquidation of their inventory. Most of their revenues come from the agriculture segment, which is a very interesting and tough industry to be able to accurately forecast because it's so tied to farmer balance sheets and commodity prices, and also with regard to population growth, because that would increase the demand for food. What we've seen in Western Canada is that it's been a very tumultuous environment for farmers. There's high leverage. There's also a very old demographic age group. So over 54% are above 55 years old, and less than 15% are under 40. And there's also an increasing urbanization of these farming communities, which has propped up the value of land. And that's a risk for service because there's kind of these farmers, their pension plans will come from their sale of their land, and it creates a barrier for entry for young entrepreneurs to come in. And with the cost of a premium brand such as John Deere, it poses a severe risk for service because just given their leverage, and they don't want to take on more risk given the suppressed crop yields, what's stopping them from going from a cheaper brand at Rocky Mountain for Case IH products? So they're kind of at a disadvantage in a weaker economic environment for that reason. So it'd be tougher to liquidate.
Right, but the market cap for this company is less than $100 million. And this company has $246 million of inventory on its balance sheet and $175 million of perhaps tangible book value. Well, maybe less than 175, but certainly north of 100. So what are your thoughts there?
I guess in terms of the tangible book value, of course, on the statements, the value is there in that sense. But I guess for us, if we're to recommend this proposal to someone, when we combine the risk reward profile and all the variant top level factors that need to come together with China's canola tariffs being lifted to help support Canadian farmers, that increased leverage of the balance sheet, because ultimately we see service as the middleman. And if their customer and their demographic base doesn't have that disposable income to be able to invest in a John Deere product, it'll be very tough to gain true profitability with this business, provided also the fact that their cash flow generation hasn't been as stable given the commoditization of the industry.
Also, just to add on to that point, we've seen historically that services actually struggle quite a bit with inventory management. So although they have these high book values, what we're seeing is that that's always not a benefit for the company, given that they also often feel like they're sitting on a lot of inventory, particularly used inventory, which again leads to the lower gross margins and less profit for the company in general.
Okay. All right, maybe another question for you. Your terminal growth rate equal to GDP, is that nominal or real GDP?
That would be real GDP.
Maybe if I could ask a question. my impression is, again, just thinking of Western Canada, I often think of wheat, and CP Rail, CN Rail had record.
That's time. Thank you.
Thanks.
Thank
Thank
you.
you.
Thank you.
Thank you.
Thank you, University of Alberta.